Hi YouTube, what's going on, and welcome back to my YouTube channel, Investing in the Rockies. In today's episode, we're going to be discussing two undervalued Canadian dividend stocks that I believe should be in everybody's portfolio. First off, I'd just like to say a massive thank you to everyone that's subscribed so far, everyone's watching the videos, everyone's liking the videos, everyone's commenting under the videos. I'm blown away by all the support, it's crazy. I think I'm on 369 subscribers so far, received more messages than I can count of people who are really enjoying the content. So please stay with me, stay tuned. I'm going to be producing as much content as I physically can on the financial side of things, and I like to do Banff vlogs here in the Rocky Mountains. So without further ado, we're going to discuss the very first stock today, which is Rogers Communications, ticker symbol RCI, and it trades both on Toronto and the New York Stock Exchange. Therefore, if you have access to either, you can purchase this stock. Rogers was formed all the way back in 1960, and it specialises in cable TV, internet connectivity and wireless communications. In other words, Wi-Fi and phone bills and paying extra money to get extra channels on your TV. Before we actually dive into the financials, I'm going to give you two reasons why I believe Rogers is undervalued today. Reason number one, 5G. Whether you like it or not, 5G is coming sooner rather than later, and everyone is going to be paying extra money to have 5G on their mobile phones. Rogers was the first company in Canada to be on the ball with 5G and to start rolling it out. Therefore, once 5G becomes available, people are going to be purchasing it, and Rogers' income's going to come up and their profits are going to go up. And we're not just talking about 100 or a few thousand people, we're talking about millions of people. Millions of people are going to be wanting 5Gs on their phone, and they're going to pay good money for it, and therefore Rogers are going to profit from this. The second reason I believe Rogers could be an undervalued stock is the fact many people are having to work from home. Many big businesses and companies have asked their workers to work from home due to what's going on in the world with this pandemic. So with many other people working from home, people need good internet connections in order to be able to do this. In the first quarter of this year, Rogers actually seen a 50% increase in their network traffic. I believe this is down to more people working from home. Also, with people working at home, people that didn't have Wi-Fi before are actually going and having to buy Wi-Fi now. Therefore, Rogers may see an increase in profits from this. I personally have friends that work for KPMG, PwC and Amazon, and they've all asked their workers to work from home. And I don't see the end of this coming anytime soon. I know for a fact Amazon have asked their workers to stay at home all the way to January next year, and this could go on even further with the way the current world is going. Who knows? So that's two reasons why I believe Rogers to be an undervalued stock. And now we're going to actually dive into the financials of Rogers and just have a look at how good the books are, and we'll have a look at the dividends and things like that. So here we have Rogers Communication, ticker symbol RCI, trading on the Toronto Stock Exchange for $56.71. This week graph just shows the performance over the last 6 months of this stock. As you can see, just before this sort of pandemic hit, it was trading at roughly $66. The pandemic hit and it went all the way down to $47. Wow, that would have been a steal if you had got in at Rogers for $47. And it's then rose back up all the way to $56 today. But if we just click the max, as you can see, Rogers has been trading all the way since January 1995, and it started at just $8. And throughout the years, Rogers has just steadily grown. A few dips here and there where there's been economic turmoil, yes, but it's always managed to recover and just keep on going. And as you can see, back in sort of February, March time of 2019, this used to trade at $72. I personally believe Rogers will get back to $72 and it'll exceed $72. It's definitely a long-term investment, but if you purchase now and hold for the long term, you'll see returns in dividends and you'll see returns in growth. That's a guarantee almost. Now we're going to take a quick look at Rogers financials, and don't be worrying about all the numbers on the page. I'm going to explain them as easily as I possibly can. We're really just going to look at the numbers in bold. So if we first take a look at the total revenue of Rogers, this goes from December 2015 all the way to now. 9.6, 10.2, 11.4, 11, 11.6, and then 10.5. That last one just stands for trailing 12 months. So we're going to expect that to be lower given that all companies have basically suffered due to the pandemic. But Rogers really hasn't suffered that much. That's not a very big drop given how much companies have suffered over the last sort of 4 or 5 months. But disregarding that, as you can see from December 2015, the total revenue of Rogers has risen steadily throughout the years. This is what you want to see when you're investing in a company. I really like the look of where it's going. The numbers are going up, so it's a good investment. If we now look at the gross profit, 3.5, 3.7, 4.3, 4.3, 4.7, 4.4. Again, this is a steady upward trend, which is what you want to see in a company when you're going to invest in them. Now, let's take a look at the all-important dividend of Rogers. So, as you can see here, Rogers has a solid dividend yield of 3.62%, and it pays out an annual $1.50 every year. So for every stock you own of Rogers, you're going to receive $1.50 back. Its payout ratio is at 59%, which is pretty good. I've seen a lot of telecommunication companies suffer, particularly with this, particularly TELUS. I think they have a payout ratio of over 200%, which is crazy. For everyone that doesn't know quickly what payout ratio is, the smaller the payout ratio, the better, as this is the percentage of the profits that are going to their dividend investors. So roughly 60% of Rogers' profits go back out in dividends. The lower this number is, the more room there is for this dividend to grow. So just on the topic of dividends, we're having a quick look at the dividend growth history here of Rogers. So Rogers first started paying out a dividend back in 2000, and they just paid literally 1 cent. As you can see, this has grown and grown throughout the years steadily. Couple of dips here and there, but that's okay. It's grown all the way now to they're paying roughly 37 cents per quarter per share. This is what I like to see, to be honest. There's been quite a steady rise from other dividends ever since it was introduced, and they've been paying dividends out every year since 2000, and I only expect this to go on and on. And as you earn more and more dividends from Rogers, what you do with them dividends, you reinvest them, you buy more stocks, and then the dividends grow, and before you know it, you're financially free. The second undervalued Canadian stock that I'm picking today is one that I'm extremely bullish on, and that's the Bank of Nova Scotia. The Bank of Nova Scotia, ticker symbol BNS, trades on both the Toronto Stock Exchange and the New York Stock Exchange also. This bank was founded in 1832 and it's the third largest bank of the 5 big Canadian banks. The Bank of Nova Scotia's financials and books do most of the talking here in this instance, but one thing I do want to point out is that it's withstood many economic downturns and came back stronger and stronger every time. I see no reason why the Bank of Nova Scotia won't have a really big recovery once the economy starts to recover. This company is absolutely huge. It has a customer range of over 25 million people. It employs over 88,000 people, and it has assets worth over $900 billion. As I said, the books do most of the talking with this stock, as well as the dividend history, which I just have to say they have been paying a dividend now for 187 years. Think about that. The Bank of Nova Scotia has been paying a dividend for 187 years. Crazy. But let's dive straight into the financials and have a closer look. So here we have it. Here's the Bank of Nova Scotia trading on the Toronto Stock Exchange for $57. This graph just shows the performance over the last 6 months. And as you can see, this stock was comfortably trading at $74 roughly just before this pandemic happened. And it dropped all the way down to $50. And now it's sitting at $57. If we just look at this stock from an all-time perspective, we can see that all the way back in 1995, it traded for a mere $6, and it's risen throughout the years. And as I was saying earlier, it's dropped during economic downfalls, but it's always covered pretty quickly. Like, look at that V-shaped recovery there back in the 2008 American housing crisis. It dropped all the way down to $30, but very quickly recovered and just kept on recovering all the way up to sort of $78, $74 just before the pandemic took place, and then it's dropped. This company has been there for years. It's withstood the test of time, and I believe it's going to withstand this current climate, and it's definitely an undervalued stock to buy right now. But let's have a closer look at the dividends and things like that. So let's just have a quick look at the financials here. This is total interest income. This value, by the way, is in millions, so this is like 15,505 million. So 15.5, 16.5, 18.5, 21.3, 24.8, and then 23.5 in the last trailing 12 months. But as you can see, there's been massive growth here in the last sort of 4 or 5 years. And if you go to net interest income, 10, 10.6, 11.6, 12.2, 13, and then 12.5 in the last trailing 12 months. Really good growth. This is what you like to see. This company's growing really quickly, and it's going in a nice upward trend. Just a quick look at the total revenue this company's bringing in: 16.8, 17.8, 19.3, 19.8, 21.2, and then 19.7. But as you can see, there's been massive jumps in the last 5 years. This company's bringing in a lot of revenue, and I only expect that to increase after the economy starts to recover. Now let's take a look at the dividend. So this has got a dividend yield of 6.39%, which is on the bigger side of the 5 Canadian banks, which is what I really like about it. It has an annual payout of $2.68 and it has a payout ratio of 67%, which isn't bad at all. If you have one share of this stock, it'll pay you a quarterly dividend of 66 cents. Now we're going to have a quick look at the dividend growth history, and this is where it's really impressive. This year only goes back to 1989, but they've been paying a dividend for much longer than that. But back in 1989, their dividend was 4 cents, and they paid out dividends every single year, and it started to rise pretty rapidly here. And as you can see, serious growth throughout the years, serious growth in their dividends. Couple of dips here and there, but that's nothing to worry about too much. And it's all the way now up to 66 cents per quarter. What was it there? It used to be 69 cents per quarter, so it really hasn't dropped that much since this pandemic took place. But that's what you get with the Bank of Nova Scotia. They're guaranteed to pay out their dividend no matter what almost. These guys have been paying out their dividends for years. They're not going to stop now. They're in pretty good shape to recover from this sort of pandemic, and I believe they're going to recover rapidly. This is without a doubt a really, really good stock to have in your portfolio. So that's pretty much it for today's video, folks. 2 dividend stocks that I recommend go in everyone's portfolio: Rogers Communications and Bank of Nova Scotia. Both of these companies have been around for a very long time, and I truly believe they're going to be around for much, much longer. So please do yourself a favor and buy both of these stocks and hold them for the long term. Watch the dividends come in, and with these dividends, purchase more stocks. I'm personally on a journey towards financial freedom, and I'm going to do this through dividend stock investing. I want to document my journey and share it on YouTube. So please, if you're interested in this type of stuff, smash the like button and hit the subscribe button, and I'll be producing as much content as I possibly can. But until then, everyone, take it easy, and I'll see you in the next episode.